range on the daily chart, and this is hypothetically a daily candlestick. And then you have Thursday's small range day, and then not to scale, but Wednesday's larger range. Okay, so we have Wednesday's daily candlestick or bar, then Thursday's smaller, which is it's higher low than Wednesday's and lower high than Wednesday's, respectively. And then we have Thursday closing with a small range day, and then Friday we have all this buy side up here that has not been engaged. After Thursday's went lower, smashed everybody's expectation of continuation. Now everybody is tricked into thinking the market's going to go what? Lower. So because we have the probabilities of seeing and I apologize if you hear a noise in the background, like this vibration, my neighbor is having trees cut down. So I had to deal with that yesterday. So in a way, I was kind of glad I couldn't actually live stream. But today, if you hear it, just know that it's something I can't avoid. There's a lot of big trucks out there cutting down rather large trees. So the Friday, large range day, we solved the issue of direction because of my prompting on Thursday telling you to look at where everything is left in your charts where they're smooth, relative equal highs. And I'll cycle through in a lower time frame and show you a couple setups that happened pre-market and overnight and in Asia last night using that same idea. But for Friday, because we're expecting the large range day expansion to occur, the direction is solved by looking where is the market leaving smooth highs or smooth lows. Well, we had Wednesday's drop down. That shift in sentiment, that means retail's looking for lower prices, go back to and revert back to a higher time frame macro perspective, which is it's an election year. So they're going to keep trying to push this monkey higher on the tree. And then what happens after November 5th, who knows? Does it stay higher on another limb or does it fall like a coconut? And then we'll see what we get. But here, the idea is that the large range day will usually occur after the small inside day. Whenever there's a small inside day, it's either the very next day or worst case scenario, the second day after. Well, you can't do that here on Friday because we don't trade on Saturday. So what are they going to do? They're going to rush. They're going to rush right at the opening bell. And you see that happening here. The open is the low of the day thus far. So what are they doing? They're rushing to get the market up here. Who is they? The algorithm. It's just simply running really, really quick to get to that level here because it doesn't want to offer the opportunity for any individuals that have their stops up there that have been holding short, looking for Wednesday's continuation on Thursday, but didn't happen. And then Friday, here it is. They run real quick for them. That sudden one directional run is going after that liquidity. So they can't pull their orders. The direction is going to be bullish, as I indicated on Thursday's tweets. I told you to focus where the market's smooth. And one of the things I learned from Larry Williams is on large range days, if it's bullish, the open is going to be very, very low on the daily range. Okay. And I know that it's going to be in the lower quarter of whatever the daily range would be. So let's do some math on that a little bit, rough math. If we know we're opening at 9:30 and we're going to view this, it's not technically the daily open, but I look at sessions the same way I would look at a daily candlestick. For me, the morning session, the high and the low, where we start and where we stop, I look at it in this perspective. This is power 3. So I'm looking for the opening when I'm bullish, and I want to see manipulation. That's the drop down, because if I'm bullish, I want to see some opposing direction. That's the Judas swing. That's manipulation. And then the accumulation below the opening price or just above it, when it comes back down and touch it again, it does not need to come back and touch it. But if it does, that's all part of the accumulation phase. And then you have the profit release portion of the run. Then you go to the target, which would be the liquidity or some higher time frame PD array. That's these two levels here. So the market trades up into them. And again, these levels, this is not to scale, but it's just the idea of Thursday was a small range inside day. And then Friday, bullish. The open's going to be near the low of the day. It's actually the low of the day here if we're looking at the morning session. But if you look at it through the lens of overnight and at midnight, there's midnight. It creates the opening here. Look at it like this. There's your opening price. Here's the low of the day right there. So this line right here, think about this crude depiction of a hypothetical daily candlestick, open, high, low, and close bar. That opening price is this. This drop down is this little tail that's making the low of the day. And then the market trades higher. It doesn't always, but it can come back and use that same opening price. What is it doing there? Trading right to that opening price. Hits it. Then it consolidates. What's it doing? It's accumulating. It's accumulating all around that opening price. It creates the first drop down. That's where smart money is going to buy. I spent my first few years trying to decipher this mystery because that was the weakness that Larry Williams admitted at the time. When I was studying everything he ever had, he said that he wished he knew the zip code of all the traders that would knew how to buy below the opening price. Okay, that was like a facetious statement that, he admitted his weakness. So he would always do what? He would be buying some portion of the previous range or an average of average daily range and take 20% of that range and add it to the opening price. And then he'd be buying up here. I tried that and it hurt me. Every time I tried to use that kind of stuff, I lost money. I'm not saying that he has stuff that doesn't work or he didn't make money with it. I'm just saying that because I was not able to be consistently following every time of doing it, I will admit to you that the losses were heavy. And when they hurt, I would be afraid to take the next trade. So I'm not going to shit on him and say his stuff didn't work. I just wasn't able to weather the drawdown that it brought with it. So because he said he couldn't figure out how to be buying below the opening price, I went back to simply saying, okay, well, you have a lot of the points already figured out. Toby Crable, he brought up some things, the narrowing of the range and the narrowest range in the last 7 days. When it creates that, he was a breakout artist. He would buy on a breakout above or sell on a breakout below. I was never interested in doing that because that's synonymous with what Larry Williams was doing then when I first started in 1992. So because it hurt me buying with a portion of the last 5 days average daily range and then taking 20% of the average daily range, if I'm bullish or if Larry Williams was bullish, he would add that to that opening price there. Well, he would actually do it here on that opening price. But because I was looking at the daily range and I was trying to figure out how I could facilitate a model that would be buying below the opening price in days that would create this type of scenario, I just went back to time. When does the day start? Midnight. So at midnight, I'm going to look for something that drops down. I don't want to chase that because I don't want to be a short seller. I didn't trust short selling. I didn't know how to do it when I first started. So I just let it drop down. And then when it gave me a bullish divergence on the stochastics, and then I had a histogram on the MACD, that was my filter. Sometimes they didn't agree. Sometimes I missed moves, and then I'd have to chase price back in the 1990s. I was afraid I'd miss that because I would think just like most of you would. You would think, oh, I'm missing the only up close day with a big range when they're going to repeat in the future. But because I was first now fleshing out these ideas into models that I would use and apply with real money, the the fear factor was too large for me to do a lot of things that I'm comfortable now. But the point is when you have a large range day expected, Larry brought a really amazing observation that I didn't notice. And I was looking at charts a lot before him, not before him, but before getting into his material. I never noticed that the opening would be near the low of bullish days. It was just completely, I didn't know about it. I didn't pay attention to it. It never drew my attention to it. No one ever called any special attention to it. But because his material talked about that, I was like, wow, as a day trader, like that's a superpower. Like that's literally like one of the wonderful advantages if you're a short-term trader or a day trader. You want to try to focus in on days when it's likely to start a price run like this, where everything is in your favor, that it's going to go one direction, find the opening price at midnight, and then anything below that price as it drops down, if it agrees with other factors that would constitute a trade, then it goes without saying that you have a high probability that you're going to be entering below the opening price, where and when smart money would accumulate their long positions. And just know, if we have an economic counter like we had this morning, we had 8:30 two news drivers, and I don't recall off the top of my head what they were. Give me a second. I don't want to say something that wasn't accurate. 8:30 we had core durable goods orders, and again, that's a medium impact news driver. You can find this information on forexfactory.com's calendar or Econo Day, and they're both free resources. But then we had another news driver at 10 o'clock. So we had a split. Notice that? We had 8:30 news, and then we had 10 o'clock news. So you got to be real careful on days that have that split news delivery, because sometimes it can create like a catapult type move or whiplash, where it sends the market one direction, not the data, but the algorithm will use that data and trip traders up, and they'll use the first set of data at 8:30, kind of like a FOMC, where the first run is the fake run, and then at 2:30 during the conference at FOMC, the real run takes place, and it's much larger in the opposite direction. Well, sometimes when you have split delivery on the economic calendar, 8:30 and 10 o'clock news like that, it can create those scenarios. But you can filter that out on days and circumstances like today, where we had the bias was bullish. I shared that with you yesterday on Twitter. I said, keep your eyes on focused on the smooth highs. That's your bias. That's me point. Look up. In other words, don't go short. Look up. And when we're looking for the last trading day of the week to go for that target or these targets that we had outlined here, that means that they're going to use the opening bell. And even though there might be a large gap here, even though that there's a 70% likelihood that it trades the mid gap, these are the circumstances and these are the types of days where it's going to say, not today, not today. So it's in a hurry, it's a rush to get up here and get to that information there.